Hey guys, welcome back to my channel. In this video, I'm going to cover the recent deflationary trend in asset prices, give you my take on what's happening economically and what that means for the markets, for investment, for our economic outlook going forward. So if you've been paying attention to the stock market, it's been reasonably flat for the past month. And it's not just the stock market. It has been gold and silver. It has been commodity prices in general. So take a look at what's going on here with copper prices. They've dropped a little bit. Crude oil has dropped a little bit since July. Lumber, of course, is continuing its deflationary trend after spiking so high in May. Wheat prices are up, but steel, and so is steel. But most of the commodities are actually down or flat, particularly oil. So the question becomes why? Well, part of the reason why, and this is going to be a chain reaction process, so I'm going to show you the chain and then I'll explain the causality behind it, is that the dollar has been rallying in the past month, okay? So you can see here how the dollar index has been rallying, and it's really been rallying since the middle of June. I'll talk about why I think it started in the middle of June later, but it's been on this upward trend. Now, part of this started in mid-August. So what happened in mid-August was obviously the debacle that is going on with the Afghanistan withdrawal of the troops. That's creating uncertainty with global issues as well, and not to mention there's also the rising COVID cases of the pandemic. So needless to say, people are buying dollars and selling financial assets, relatively speaking. There's not a lot of action going on, but it's enough to be noticeable here. But what I think is pressing the dollar up, okay, I think what's pressing the dollar up really isn't due to COVID or what's going on globally. I think the major issue, because this really started back in mid-June, has been the United States debt, okay? So if we take a look at what total United States debt was on June 15th, it was standing at $28,322 billion. And since then, in the matter of 2 months, total government debt has only increased by about $100 billion in that month. Now, that $100 billion may sound like a lot, but if we annualize that, that's really only $600 billion of debt added to the economy, compared when for the past several years, even before COVID, we were having over $1 trillion plus deficit. So that means we were having more than $1 trillion of debt come out into the markets. And especially with COVID in the 2020, with the pandemics and the government shutdowns and record government stimulus, we issued out trillions of dollars of debt. It was like over $3 trillion, and we were supposed to be like that again. And yet now, and especially for pretty much the past month, debt has actually been trickling downward. Okay, so July, mid-July, debt kind of peaked right here at $28,533 billion, and now it's down to $28,428 billion. Well, why? Well, it's because the debt ceiling has been reached. Okay, so the government has literally reached a point where it cannot raise any more debt. Legally speaking, the Treasury's arms are tied. They are not allowed to levy out any more debt into the economy until Congress agrees to raise that debt ceiling and allow the government to issue out more debt. So what's been going on is that debt has been coming due, past Treasury bills have been coming due, and the Federal Reserve is paying down with its general Treasury account, which is like the checking account for the Treasury, okay? So the Treasury is got a checking account at the Federal Reserve, and right now it's got about maybe $300 to $400 billion, and they're using that money to float until Congress can agree to raise that debt ceiling, okay? This is having, I believe, a deflationary effect on asset prices, as well as in appreciating the currency. Okay, and one of the things that I want to point out is that the money supply has noticeably been slowing for the past couple of months. I noticed this originally back in when July's numbers came out. I'm sorry, when June's numbers came out. But I wanted to wait. I wanted to wait and until I got confirmation with July. Okay. And so in June's numbers came out. Before this, we were averaging over 1% per month. Okay. We were averaging over 1% per month increasing of M2, the money supply. And then for the last 2 months, we've only been averaging 0.4% increase. Well, what's going on? The Fed's still printing money. It's buying treasury bills and it's buying mortgage-backed securities. Why is the money supply slowing? Well, I believe it has to do with this debt ceiling, and you're going to have to follow me on this process here. You see, when the federal government issues out debt, it issues it out and sells it to banks. Banks will then buy it, but for the last 15 years almost, post-2008, banks have been holding records amounts of reserves stocked away at the Fed. And basically what's been going on is that they have been swapping out reserves for those treasury bills when governments issue out those debts. That's why the interest rates on federal debt has not really been going up. They've actually been steadily climbing downward for the past 13 years. It's because banks were flooded with all this cash, this printed money from the Fed, and they stashed it away at the Federal Reserve, trillions of dollars of this, and used those reserves to swap out and buy those treasuries. Well, why would they do that? Well, post-2008, the Fed thought it prudent that banks should hold a certain amount of minimum collateral, bigger than the minimums if there were any allowed before 2008. They believed that that the lower amount of collateral made banks susceptible to crashes in the economy, and by forcing them to hold higher amounts of capital will force them to hold and stash away more amounts of cash to prevent such a crash in the economy where banks were literally found themselves underwater and over leveraged on loans made out in the private sector. And of course, this collateral could only be the safest debt instruments to hold. And what are the safest debt instruments believed to be in the U.S. economy? Federal debt. So it's no surprise here that reserves would build up. The Fed would purchase treasury bonds from the banks, flood them with money, and then the banks would stock it away at reserves to buy the next round of treasury bonds from the government. So essentially the Fed has been monetizing our debt for the past 13 years, which is technically illegal, but because they're using the banks as a medium, they're allowed to get away with it. It's really, truly fraudulent. They're not supposed to be doing this. This kind of monetization of debt leads to price inflation, okay? But what's going on in the past couple of months is that the U.S. government is not levying out more debt. On the contrary, we're paying down debt. So add to the fact that the Federal Reserve is purchasing debt from the banks, and now the banks have got these collateral minimums. So they've got to go out and buy these treasury bonds. They've got to go out and buy treasury bonds off the market, and there's less available, okay? So these are keeping interest rates at record lows. This is also what's keeping the 10-year treasury rate at record lows. And let me pull that up right now. I'm going to pull up the 10-year treasury rates right quick so that way you can see in real time how these rates are staying stable, and they've been staying stable since the spring, really. They've been dropping, but notice how they have been remarkably stable and dropping even from June, okay? They've been kind of fluctuating in this channel between 1.2 and 1.4%. And why? Because the federal government is no longer levying out debt temporarily. So this is having downward pressure on asset prices because normally speaking, the money would be changed out for reserves, okay? So banks would give up some of their reserves, get some of this debt collateral, then they would trade with each other. Well, now banks are given all this cash, but they have these collateral requirements. So the cash is not coming out into the private sector markets to be loaned out where money creation goes up, right? That would increase the money supply. Instead, they're just forced to stock it away at the Fed. And by stocking it away at the Fed, it essentially is not in the system. It's not circulating in the system as new money. Therefore, it's not having any price increases, and that would explain why the money supply is slowing. Essentially, the only thing that's propping up the money supply now is the Fed buying $40 billion of mortgage-backed securities, because typically speaking, those mortgage-backed securities, although they can be used as collateral, aren't used as collateral. It's been treasury bills that have been. But yes, mortgage-backed securities of the highest quality can be used as collateral to be used to issue out for repo loans, okay? So with all of this that's been going on, this is not really causing much more new money to come out into the market. If there's no more new money to come out into the market, well, then prices can't be bid up. The commodity prices are kind of leveling off right now. This is having a downward pressure on the stock market, which has been inflated by Federal Reserve expansionary monetary policies, and the slowing of the growth rate of the money supply is threatening those price increases. And that's why gold and silver have become remarkably stable, and that's why the dollar index has actually rallied. So ironically speaking, the political gridlock that's been going on in Congress has kind of held off the inflationary spiral that we've been seeing earlier on in the year, and has been delaying this inflationary increase. So this is throwing off completely my entire inflationary timetable. I mean, these numbers are slowly edging down, and I would imagine that they're going to edge down for the next couple of months. So no longer do I expect that August's numbers are going to spike here in the money supply. As a matter of fact, I'm willing to bet that the numbers are going to be more closely to 0.4 or 0.5% monetary inflation. As a matter of fact, I'm going to go ahead and change that and just go ahead and see what that does to my inflationary number. So overall, it didn't really change it all that much. It changed it a little bit here, but it hasn't really changed it by any kind of huge amounts that's been going on. So anyway, that's my take on what's been going on. This is going to continue for a couple of months. Does this mean that the inflationary crisis is over, or that we could go into a deflationary crisis? Likely not. It means that things are paused for now. Now, obviously, I have been one that has been warning about the dangers of price inflation. It is possible that through a slowing of the growth rate of the money supply, if this trend persists, which I don't expect it to persist past September, even with Fed tapering, because the government will issue out new debt, which will cause more money to flow out into the economy again. But all that being said, I do expect that it will kind of throw off these inflation numbers and make them a little bit lower, particularly in the short term. Long term, it probably won't change things all that much, but in the short term, it could. And particularly with commodity prices, we may even see some deflation go on in commodities in the next few months, which will then lower the inflation on the consumer prices. But it's got to come down that chain first. It's got to start with raw material commodities, then proceed to intermediate goods, then proceed to final demand goods before coming out to consumer goods, okay? So it's going to take several months for this to come out. But by the end of the year, I expect that the Fed will be barking and harping on its narrative that inflation is contained and under control. Well, no, the Fed didn't really do anything to make this under control. They basically got lucky that gridlock in Washington is preventing the government from spending the Fed's printed money, and the Fed is strong-arming the banks to prevent them from loaning out the money, which is going to slow loan creation, which is going to slow the money supply growth creation, which is going to keep these prices deflated, which also means that returns on investment cycles are going to be limited for all asset prices. So cryptocurrencies will be limited, stocks will definitely be limited, so will precious metals until this crisis is over. Now, as we get closer to that crisis point in September, when it becomes clear that we're in a debt ceiling crisis, and the more that Congress stalls on this, the more that I expect that the stock market will fall, and gold and silver might actually go through a rebound, okay? So we might actually see where gold and silver will pop up a little bit during the final days. It won't happen until probably the second half of September, but I would suggest that we could easily see silver pop back over $25 an ounce. We could see gold pop back over well over $1,800 an ounce, probably on the way to $1,900 an ounce, if that situation were to develop. And I do expect that to develop. But in the long run right now, it doesn't really change much, but in the short run, we could be seeing that the Fed could be barking on its narrative that says, oh, well, inflation's coming down, it's under control. Now, consequently, this could cause the Federal Reserve to stay the course and keep asset purchases going on longer, which, of course, in a perverse sort of way, until September's debt ceiling issue is resolved, could could cause a spiraling effect of deflation, so to say, as reserves are built up in the banks. But ultimately speaking, that money is still going to come flowing out. And unfortunately speaking, it's going to come out through the government markets. It's going to come out through the general treasury account. It's not going to come out through private loans granted to businesses relative to government, to loans to government. And in the essence, it's your private businesses that make the wealth and resources. It's your private businesses that grow the food out of the ground. They're the ones who make the cars. They're the ones that make the technology and the computers, tools, and equipment. And if the money's not going to them, then it's going to be squandered more by the government. Okay, so in the end, it will be probably more inflationary on prices. And because there may become a decoupling between the producer price index and the consumer price index, I don't expect the consumer price index to just start dropping all of a sudden, but it could level off by, say, October, November, as we work through these relatively lower commodity prices or lower growth rates in commodity prices. So chew on that, think about that, and let me know what you think about all this. Is very interesting stuff. Again, this is all very complicated, so there's always going to be changing market dynamics, and I'll relay this information to you as it comes across and as I try to understand and digest the information that's coming across to me, okay? So guys, thank you for watching this video. If you like my content, make sure you click that like button, hit the subscribe button, click that notification bell, just show me some support. Comment on the video, let me know what you think, and until next time, I'll talk to you then.